It happens at the closing bell, not in the press conference, not in the CPI print, in the options chain. Today, a single monstrous order for weekly calls lands on a dealer's book, and the entire leverage machine groans. The market calls it volatility. It's not. It's a structural echo. Because here's what happened. Plain and brutal. A major trading desk, pinned short gamma by a tidal wave of speculative calls, becomes a forced, algorithmic buyer of the underlying. They aren't bullish, they're trapped. And their trap becomes the market's truth for one violent hour. The screen price screams higher. The dealer's risk model screams panic. Same asset, same moment. Two different realities. One market chasing a breakout, the other market scrambling to hedge a broken formula. That disconnect is the smell of modern finance. It's not sentiment. It's algebra dressed as a rally. Fact. The dealer system is the invisible plumbing of every liquid market. Interpretation. When a big enough options bet disrupts that plumbing, the flows reverse, pressurize, and flood the hallways. Price becomes a byproduct of risk management, not valuation. Now watch the contradiction. Paper liquidity feels infinite. Real liquidity, the kind that absorbs a sell order without moving the price, evaporates when you need it most. Today proved it. A banking holiday in London, a closed session in Asia, the Fed on mute, waiting. The liquidity pool was a shallow pond, and into that pond, they dropped a boulder. The splash wasn't a trend, it was a measurement of how thin the buffer has become. Look at the depth of book, not the ticker. The depth of book is where confidence goes to die. When the buy side evaporates 3 ticks down, you can't argue with an empty queue. In normal times, dealers provide that buffer. They warehouse risk. But on days like today, their mandate flips. They are not warehousers. They are amplifiers. Their models force them to buy as price rises and sell as it falls. It's a pendulum pushed to its extreme, and the entire market swings with it. This is the mistake most observers make. They see a green candle and think conviction. They don't see the frantic sub-second hedging orders hitting the tape. The dealer buying not because they want to, but because their VAR model says they must. That's not capital allocation. That's computational panic. So we need to talk about the only metric that matters when the algorithms take over, gamma exposure. Gamma is the accelerator. When dealers are short gamma, short a wall of calls like they were today, they are forced to buy the underlying as it rises to stay neutral. It's a feedback loop built into the code. Every tick up forces more buying. The rally feeds itself until the momentum exhausts or the gamma flips. This is why moves feel magnetized. It's not magic, it's math. And when you combine that math with a liquidity vacuum, you get what we saw, a parabolic spike on air. It looked like a bull market. It smelled like a bull market. But it was a machine eating its own tail. Let's define the trap in one line. It's when price discovery stops being about value and starts being about dealer positioning. Why it matters? It means the market is telling you more about its own internal stress than about the asset it's pricing. Today, it was screaming. Now, we're not gambling, we're measuring. So let's measure the stress signals. The block trade size, it wasn't a whisper, it was a shout. 50,000 contracts in a weekly expiry. That's not a bet. That's a declaration of war on a dealer's balance sheet. The skew, the frantic rush for out-of-the-money calls while puts stagnated. That's not hedging. That's a lottery ticket bought with leverage, and the dealer has to underwrite it. The market depth. The way the order book on the futures side just vanished, as if someone pulled a plug. That's the physical reality behind the paper promise. When the depth goes, the price is just a number in search of a trade. Now, zoom out. The last few years have been a slow, steady drainage of real liquidity. Regulations, risk aversion, the consolidation of market makers. The system's shock absorbers have been replaced with tighter springs. That's not a theory, it's observable. And observable things don't care about narratives. So when the market walks into a low liquidity session with these brittle springs, then a gamma event hits, the question becomes simple. Who sells to the forced buyer? The answer is where the volatility comes from. If there's no natural seller, the price has to rocket until it finds one. It has to incentivize someone, somewhere, to part with their asset. That's when price stops being an assessment and starts being an auction. This is where the paper-to-physical ratio of liquidity turns from an academic concept into a hazard sign. On paper, billions can trade hands. In reality, only millions can trade without moving the price. Most of the time, it's fine because the crowd never tests the limits. They trade the illusion of depth. But what happens when a dealer is forced to test it? That's the uncomfortable part. The dealer doesn't have a choice. Their model is their mandate. They must buy. So imagine the real-world scenario. The block trade hits. The dealer's risk system lights up red. The auto hedger kicks in. It starts buying futures. But the futures market, seeing this relentless bid, pulls its offers. The buyers dry up. The price gaps. The very act of hedging creates the volatility it was meant to insure against. It's a snake eating its own tail. If that dynamic ever goes mainstream, if the crowd realizes the tail wags the dog, the trust crack becomes a self-fulfilling prophecy. Not because the asset changed, because the understanding of the mechanism changed. Markets run on confidence in the process until they don't. Now pay attention to the timing. This isn't a vague someday story. The trade is time-stamped. The liquidity data is time-stamped. The gamma grid is time-stamped. The stress is time-stamped. And the crowd is still acting like this is just another pre-fed wiggle. It isn't. Because modern markets aren't just about shares and earnings anymore. They are about derivatives, leverage, and algorithmic symbiosis. They are the central nervous system of the digital economy. We can debate targets all day. We can throw around resistance levels. Those lines are entertainment. The real question is what breaks first? Does the liquidity return? Does volatility calm? Or does the system admit it can't handle the size it created? Let's look at the supply side of liquidity without the fairy tales. Real liquidity doesn't come from more screen traders. It rides shotgun as a byproduct of market maker profitability and risk appetite. That means the liquidity faucet doesn't open just because volatility spikes. If the economics of making markets don't justify the risk, liquidity doesn't magically flood the system. That's what inelastic liquidity looks like in the real world. It's not a textbook. It's a balance sheet constraint, a regulatory capital charge, a risk manager's ulcer, and a decision made in microseconds. So when you hear higher volatility will bring in more market makers, we should respond with one line. Show us the balance sheet. Because without willing and able warehousers of risk, the system is trapped. It can only rebalance through price. Either price moves enough to lure in a natural seller, or price moves enough to blow out the speculative positions. And the dark irony is this. The dealer's hedging flow doesn't blink. An algorithm can't replace its mandate with hope. It can tweak, optimize, slow down, but its core function is stubborn. Code is stubborn. Logic is stubborn. Physics always wins. Now, let's talk about today's move like engineers, not tourists. A gamma squeeze doesn't have to be a conspiracy to behave like a conspiracy. If you shrink the available liquidity, raise the volatility, and concentrate positioning into a tight expiry, you create a powder keg. You create optionality for chaos. That is fragility. And we've seen this movie before with the volatility index itself. A few big bets, a short squeeze, and an ETF structure blows up, forcing billions in forced selling. Gamma is even more sensitive because the feedback loop is faster. So ask yourself this. If you were running a dealer desk facing an existential mark-to-market loss on a short gamma position, would you prioritize elegant theory, or would you buy the futures to stop the bleeding? That's not a moral question. That's a survival question. Now, here's the part the commentators keep missing. The market can have billions in notional value traded, but true depth, the kind that soaks up a real order, can be paper thin. That's a structural mismatch. And structure isn't built overnight. So the Fed can hint, the analysts can rationalize, the media can explain. But in the short run, the price discovery mechanism only has one answer, gap. And when it gaps, it doesn't just reprice the asset. It reprices the risk for every portfolio holding that asset, for every option written on it, for every volatility target fund that uses it as input. This is why the skew matters. Skew is the early warning siren. It's the options market admitting quietly that the futures price is not the full story. Now, let's separate fact from interpretation one more time because we don't do fake confidence. Fact, a massive one-sided call block traded today. Fact, market depth was severely reduced due to holidays. Fact, the subsequent price action was parabolic and isolated to the nearest expiry. Interpretation, the probability of a similar liquidity-driven flash event is higher in the coming weeks. Not because fundamentals are deteriorating, but because the system's shock absorbers are worn and positioning is extreme. Possible risk, volatility collapses, dealers rehedge, and the panic resets. That can happen. We don't worship one outcome. But even in that case, the floor of stability is lower than in past cycles because the structural leverage is greater and more automated. Now, what should we watch first? Not the S&P level. Price can be puppeted. Watch the gamma levels across key dealer desks. Watch the put and call volume ratios in the 0 days. Watch the order book depth on the futures exchange itself. Watch how quickly liquidity vanishes on a 5-minute chart. Watch whether VIX futures trade in backwardation. And watch the language. When official market summaries start using words like technical buying, dealer hedging flows, liquidity-induced move, that's the smoke. If we see smoke, the structural fire is already burning. Here's a question that should make you uncomfortable in a good way. If the market needs deep, resilient liquidity to function, why are the order books emptying at the first sign of stress? And here's the second question. If paper claims to liquidity are plentiful but actual executable bids are thin, Which metric is telling the truth? Now, we need one clean disclaimer because we manage risk. This is educational, not financial advice. We don't gamble, we size positions and accept uncertainty. Now, let's talk about what the next week could look like in 3 lanes without turning this into a numbered lecture. Lane 1 is the smooth reset. The call buyers take profits. Dealers patiently unwind their long futures hedges as gamma decays. Liquidity returns with the Asian and European Open. Price drifts back, consolidates. The event is forgotten, a footnote. Lane 2 is the persistent stress. The extreme skew persists. New speculators, smelling blood, pile into more short-dated calls, keeping dealer gamma exposure negative. Every rally attempt gets amplified. Every dip is shallow and quickly reversed by forced hedging. The market moves in jagged, unstable steps, magnetized to the strike walls. Price action feels broken. Lane 3 is the break. A second, larger gamma event compounds the first. A major hedge fund or dealer faces a margin call related to the volatility spike. Forced selling begins in an unrelated asset, spreading the contagion of illiquidity. The VIX term structure inverts violently. That's when price stops being a chart and becomes a binary outcome, a failure of the plumbing. Which lane are we in? We don't have to guess tonight. We can read the signals. And the signals at the close look like lane 1 praying it doesn't become lane 2. Because when you see a market with gamma screaming, with depth absent, with skew at extremes, you are looking at a system under tension. Tension doesn't resolve politely. It resolves with a snap. And here's the psychological trap. When the market spikes like this, the narrative immediately floods in to explain it. The Fed is dovish. A short was squeezed. These stories provide comfort. They suggest a cause, an order, a reason, but they often come after the move. They are the rationalization, not the catalyst. The real catalyst was silent, mathematical, and inevitable given the positioning. So if you're watching only the news ticker, you'll get whiplash and miss the real story. The real story lives in the options chain and on dealer balance sheets, not in headlines. Now, let's bring it back to the timestamp on the tape. 3:05 p.m. Eastern isn't a forecast, it's a symptom, and symptoms matter most when the patient is already weak. This is why the next few sessions are dangerous and important. The market will try to normalize this. Analysts will call it an anomaly. Traders will call it a gamma blip. Commentators will say, we've seen this before, but the setup is different now. The liquidity is shallower. The reliance on derivatives is greater. The automation is more pervasive. The structural leverage is high.